Welcome to our podcast series, Talking with Traders, hosted by expert trader Garth McKenzie in London, from where he's interviewing various guests on the topic of trading.
Welcome back to another season of Talking with Traders with me, Garth McKenzie. This is the 6th season of the podcast, and we're into our 3rd year since the podcast began in 2020. Once again, IG have come on board as sponsor and agreed to fund this podcast for another season. We really are privileged to have such a global leader in CFDs trading as our podcast sponsor. Over the coming weeks, I'll be interviewing various guests from around the globe to bring you their market insights. I'll be digging in to find out what makes them tick, how they see the markets in the year ahead, and what techniques they will use to succeed in the markets. Some of the guests will be returning guests from previous seasons, and some will be new guests that I've managed to convince to join me to give up their time and share their insights. As we enter 2023, there's as much uncertainty as ever around where the markets may be headed in the next 12 months. We've just come off a horrid year for investors in 2022, where a typical 60-40 portfolio delivered its worst annual return in several decades. But what of 2023? Will the US lead the world into a global recession, or will the central banks manage to achieve a soft landing for the global economy? Will inflation come under control as base effects kick in and supply bottlenecks open up? Will US earnings hold up in the face of a weak economy, or will they disappoint? Will we see continued weakness in the US dollar? I'll be asking these and many other questions to my guests in the coming weeks. The idea behind these podcasts is for you to get a variety of views from a broad spectrum of market professionals. None of this is intended to be seen as financial advice, but it is intended to get you thinking and to weigh up what possible paths the market may follow in the year ahead. Please remember to subscribe to this podcast in your favorite podcast app. That way you'll be notified of upcoming episodes as they get released. Once again, thanks to IG for sponsoring this podcast for a 3rd consecutive year. Thanks for joining me, and please enjoy Season 6 of Talking with Traders. Welcome back to another episode of Talking with Traders. This is actually the penultimate episode of Season 6 of Talking with Traders. We'll soon be coming back with a Season 7 in a couple of months' time as well. But for this episode, it gives me great pleasure to welcome back one of our first guests who appeared on the podcast in 2020 when we started this podcast 3 years ago. His name is Siam Kidd. He's from London. Siam, welcome back to the podcast.
Hey, thanks for having me, buddy. Season 6. Jeez, you've been going some.
Yeah, we've been going. Been going flat out since I last interviewed you.
Nice.
So it's good to see you again. Just to remind the audience that you and I met originally in South Africa at an IG Markets seminar, which was a live event. You were the guest speaker, but you were the big speaker, the big main act coming all the way from London. You talked to us in South Africa at that stage in Sandton, and I was one of the speakers as well. But I remember we got along really well. And when I was listening to you present, I kind of felt like we were very much cut from a similar cloth in the way we see the markets, the way we try and portray it in a fairly realistic light and not dress it up to be more glamorous than what it actually is. Mm-hmm. So it's good to have you back after a 3-year hiatus, I suppose, or 3 years since we last spoke to one another. Let's get on it. I mean, in our last podcast, you were very bullish on crypto, and you said that you were putting a lot of your money into Ether, and obviously what happened since then, that was 2020. I mean, crypto went bananas. Ether went up probably 10x after that, if not more. But then it also subsequently crashed all the way back down. So I want to revisit that and ask, how's it been? Did you hold for the whole time? Do you still hold? What's the plan?
Yeah, so in a nutshell, it was ridiculous. So in the 2017 bull market, like the whole pot went up over 10,000%. It was like I won the lottery. It was ridiculous. 2020 to 2022, again, that was still thousands of percent. And so been an awesome ride. However, I did lose a fair chunk in 2022, which was ironic. because if you look at my YouTube channel, I called this bear market. I remember there was a video I put in, I think December 2021, going, beware of the January shenanigans, moving into 2022. This is where stuff starts getting bubbly and toppy. And then throughout, I said, yeah, we're in for a bear market now. And I got so much shit on the way down, going, oh, no, it's not the bear market. We're going to 100, 200K, blah, blah, blah. Loads of shit. And then obviously everyone was like, oh, yeah, it's a bear market. And then now towards the bottom, I'm like, yeah, I still think there's a bit more downside to come. And I'm getting shit again. So it's a bull market now, Simon. But no, I lost a lot of money last year in 2022. So the ironic thing, sorry, I forgot to say, is that even though I called the bear market and I moved to cash, so literally I've been in cash for almost 15, 16 months now.
Right.
The few trades I did place in 2022 were ridiculously bad. So yeah, I lost probably just over £2 million last year.
Goodness me. Okay.
So, yeah. And again, annoyingly, those trades were directionally correct. But I just mistimed it slightly. So I remember there was one really bad ETH trade. What was it? Yeah, it was around November time. So we were having a bit of a pullback. I can't remember the exact numbers, but it was something like, it went down to about 1,000 or 1,200. It was pulling back to about 1,600 or something like that. And I was like, right, this is just a retrace. I'm going to short the shit out of this. So I put in a pretty big short, and my stop loss, my liquidation, they're two different things, stop loss and lick levels, but the price was sort of creeping up towards my stop loss, not my liquidation level.
Right.
And it was still looking really bearish. Like, one of the things I do if I'm in a trade which isn't going to plan, I go, right, fresh slate. If I saw the chart right now, would I still place this short?
Yes.
And every time I did that, I was like, yeah, this is still a really good short. So I held on. But because I was trading on GMX, which is a decentralized exchange, and the size was quite chunky, the borrowing fees were ridiculous. It was costing me about $9,000 per day to hold the trade open.
Wow.
So all of a sudden, I was in a different type of risk to reward seesaw. So no longer was it a case of, is this definitely going down? And I was so positive it was.
Yeah.
The risk to reward seesaw that was going on in my head was, okay, I know it's going down. I'm like 90% confident ETH is going to carry on crashing down. But when? The when was the variable I wasn't sure. So the risk to reward seesaw was, right, okay, how confident am I that it's going to crash within the next month? I can't remember what my stats were at the time. And then, okay, so let's say it takes 30 days to continue. Then I was like, okay, well, the risk is 30 days times $9,000 a day. I was like, oh, can I risk another couple of $100,000 just to keep the trade open, just to see? And what if I was wrong? So I could have blown another couple of $100,000 in borrowing fees, and the trade would have bombed out. So in the end, I pulled it. And what happened 4 days later? It went down to like $800.
Yeah. Yeah, it's a pity. But what you say there is interesting about the timing, because if you're right, if you're in the physical coins, crypto, well, then you're not paying those financing costs. However, if you're doing it through a derivative instrument, which is, like you said, you were, they are very expensive. And I know I experienced that myself, trading a CFD on Bitcoin, not knowing. And then I looked at my financing cost and I thought, goodness me, this is costing me like nearly 100% per year in financing. I don't know why it is so expensive, but that's what it is. And it was outrageous. And I thought, oh, okay, all right, this is definitely not the way to be trading crypto. If I'm going to do this, I need to actually do the physical and not be paying away these exorbitant financing costs.
But you can't short the market with
spot. I know, that's the trouble. Exactly. And that's the bummer, right? Is that often with instruments, when you short them, you actually earn interest. But it's not the case with crypto. They still charge you.
Because the DEXs, they still need revenue and stuff to pay their shareholders. Now, when we spoke the last time, you said that you were primarily a forex trader. So I want to just get a recap on that. Are you still trading a lot of forex, or are you mostly crypto now? What's your focus these days? I stopped, I think, all FX in 2020, or even before that, maybe.
Okay. So, why? What's the reason for that?
Well, I got into crypto like properly in 2016. Obviously, we had that lovely bull market in 2017 and whatnot, and I just found it a much no, easier is the wrong word. I'm lacking a word here, but I preferred trading with crypto because it's just more volatile. And as a trader, I like volatility. Sometimes, not always. I mean, if you're doing a range strategy, then yeah, volatility is your friend. Sometimes you just want a nice, lovely trend that is nice and stable. So and also I think mainly it was because I've also got the realistic trader community, right? Which since 2013, that has always been an FX education company. But because of the rules in the UK with the FCA, I'm not allowed to look, pull up a chart of euro dollar and draw some lines on it and go, hey, this is resistance, this is support. I think we could see this, because the FCA construes that as financial advice.
Okay. And are you not regulated on the realistic trader then?
No, I'm just an educator.
Yeah. Okay.
So my hands are tied behind their back. So what it meant that even though they're, my clients are paying a membership to be a member of a community, even me just doodling on some charts or whatever and say, hey, this is my trade, I'm shorting it, like that, the FCA deems that as still financial advice.
Right. So, okay. So then, but crypto not being regulated then means you can get away. You can draw lines on charts and tell people what you think, and that's
share
fine.
My trade.
And share your trades.
Like my community, I literally every trade I do, I take a screenshot, I share everything. They have access. They see my trading log. So
yeah. And that's actually something I should have done in the intro, to be honest. And I got carried away with telling people how we met. But actually, just in terms of where you fit in and what you do, you run the realistictrader.com, which, as you said, is an education platform for traders. Who are your clients on there? Mainly DIY traders? Do you have any institutional?
No, it's just small. Typically, I would say half are small to medium, small business owners that are doing well in their businesses and they're looking to learn the markets.
Right.
And the other half are middle level managers and higher. So people with a job but earning, let's say north of 40 grand a year.
Yeah. Basically people who trading for themselves, they're taking it on, but they want a little bit of guidance from someone who's a professional and knows the market.
Yeah. And how to learn properly, because, what you see for free on Google is definitely not the stuff that works.
No, that's right. Not all of it. And I mean, I think that's where where I felt that you and I had a kind of a similar way of seeing things, in that trading is not all about the glitz and glamour that they make it out to be on the internet very often, where you see the adverts with the guy with the Lamborghini and the helicopter or the yacht and the pretty girl and trading off a laptop on the beach. I mean, I don't know if you've ever traded off a laptop on the beach, Siam.
I have, and it's bollocks. There's sun glare, it's hot, the laptop heats up, you can't see anything, there's no Wi-Fi on the beach typically.
No.
So you then go to the hotel pool, you still have the same issues, you're sweating like a bastard.
Yeah.
It's a suboptimal trading environment.
It totally is. It totally is. And also, if you're on holiday, don't go trading. Rather enjoy your holiday. That's always been my philosophy. Through the years, I've gone on occasional holidays and taken positions with me, and it actually just ruins your holiday. Rather just go flat, enjoy your holiday. The market's always there when you come back, and the opportunities will always keep coming. So don't mess up your holiday with the trading positions open.
Agreed.
Yeah. Now, can you take us through what a typical trade might look like? Because I know you mentioned lines on charts, so you look at technicals. I know that. I mean, do you have a specific sort of a routine or rigorous process that you go through when setting up a trade? And let's talk about a crypto trade now, for example. I mean, I don't know if you can give us an example of a trade and what they typically look like.
Yeah. So your viewers, are they watching this in video or audio?
They're watching it as both, so that it's video on YouTube, and then we're also doing the audio for all of the listeners of the podcast. So it really is marketed as it's marketed as a podcast. So probably best to rather talk and tell us about it rather than share your screen, because the many listeners who are listening to this as a podcast while they're driving their car or going for a jog or on the train, they aren't going to see any pictures. So you have to talk to us with words. Show us with words.
Damn it. words are my weak point. Okay, so yeah, first of all, you need a quiver of arrows in your arsenal, so to speak. So,
Yeah.
and in fact, going back even one step further, you have to identify the market conditions. So a lot of people think, oh, it's up, down, and sideways. They are the market conditions, but it's wrong. There's 6 market conditions. So you have steady and volatile. So they're the conditions. And then you have, range, bull, and bear. So when you look at that quadrant, there's the 6 things. So what you need to, first of all, identify is that whatever strategy you have, you need to know which arrow goes into which market condition. So what a lot of newbies do, they'll go to something online, Google or whatever. They'll find some, I don't know, moving average crossover system or whatever they found in some forum, and they'll try and backtest it. And if they're lucky and they've managed to backtest it in an environment which looks good, they'll, oh yeah, this is really good. And let's say it's a steady trending strategy, moving average crossover, blah blah blah. And so it's great. But then what happens when the market turns into a volatile trend, which it does towards the end of a rally? All of a sudden they could get stopped out or wicked out of some sort, and then all of a sudden it starts topping, and now it's a volatile ranging market, and then all of a sudden this stupid crossover system doesn't work. And so what the average Joe does is go, oh, this is bollocks, I'm going to skip to the next strategy. And they spend their lives, years even, like I did to begin with, strategy hopping. So first of all, you need to know, okay, I have strategy A, let's say. This strategy can only be used in a steady trend. Cool. Okay. So, and the reason I say you need a few, because one strategy won't get you every move up or down, etc. So, to simplify things down, let's say I've got 6 main strategies. They cover a bunch of different market conditions. So every morning when I say morning, I'm a late one, so I normally wake up at about 11 in the morning. But so I walk over to my office in my underwear, which is in my house, obviously. Open up the screens, and once I've cleared the grog from my eyes and whatnot, I'll just run down TradingView. So I've got a big watch list of basically the whole crypto market, and I start from the top down. So although it doesn't change much, I always start with M2, so US M2. What is the US currency supply doing? Now, 90% of the time, it will have done the same thing as yesterday and the day before and the week before, but it's worth knowing whether, is the US currency supply contracting or inflating. Then I look at the US dollar, and then obviously the dollar dictates everything, because any asset that's priced against the dollar will be inversely correlated. So if the dollar is dropping, gold tends to goes up. If the dollar's dropping, Bitcoin goes up, stocks go up, stuff like that. So there are all of these correlations everywhere. Then I look at the main markets, so the S&P 500, the Dow Jones, FTSE, DAX, all that sort of stuff. Now, again, I already know by this time, I've already seen what the dollar's doing. So if the dollar's going down, I'm almost anticipating that main markets are going up. Sometimes there's a lag of a day or two, but it's normally, I think the last time I checked the correlation, it's something like a 90% inverse correlation. So, and so let's say, stocks are going up today. Let's say I'm looking at the daily chart. I'll then know almost know before I even look at the Bitcoin chart that Bitcoin's most likely going to be going up as well. Because Bitcoin is roughly 85% correlated to the S&P 500, the NASDAQ, Dow Jones. So I know like a lot of crypto purists are like, crypto is the Noahs Ark to the financial system, blah, blah, blah. Well, at the moment it isn't. Well, it is. But when you're looking at normal sort of intraday trading or, normal trading, it's basically correlated 85%-ish.
Yeah, the most definitely it has been the case recently. I mean, there's this, like you say, it's when risk assets are moving up, Bitcoin and cryptos are moving up, and vice versa. So they're not this. I think it's been disproven, this idea that these things are uncorrelated to markets. That's not the case. Cryptos they're risk assets, just like equities and gold and all these other things. They are risk assets, and they move the way risk assets move.
Yeah, and even if it sort of amplifies that as well, because let's say you're an institution or a big company with a bunch of different assets, and all of a sudden market, things go risk off. You're like, shit, stuff is happening. what's the first thing that they sell? They'd much prefer to sell their Bitcoin than their Apple stock or Tesla stock or whatever. So typically, if you're a big boy or a big company, whatever, it's the crypto that's first to be sold rather than your Apple stock. And if shit really is hitting the fan, then then you dump your Apple or whatever. So yeah, still risk on. But the caveat to this is the bigger picture. I do believe crypto or Bitcoin is the Noah's Ark, because if you look at the chart of the amount of Satoshis per dollar, like the purchasing power of the dollar against Bitcoin is dropping like a stone. So with potential big inflation or hyperinflation, blah blah blah, Bitcoin is the daddy. So that's a little caveat before a lot of Bitcoin maximalists go, it is a lifeboat. I agree. It is a lifeboat. So going back to the daily thing. So then I'll find my way onto so after main markets, I look at oil, copper, natural gas. Just I don't trade them, but I like knowing a little about a lot. It's not it forms part of your big fuzzy peripheral vision. And like, for example, this morning, natural gas has just spiked up. Interesting. I don't know why. I haven't even bothered looking at it, but it's in my knowledge base. So then, only then do I look at Bitcoin. So I'll start on the weekly chart on Bitcoin, then the daily chart, then the 4-hour chart. Now, each of my strategies, going back to the market conditions, you also need to know which time frame to trade them on. So I know some of my strategies don't work on the daily time frame or the 1 hour. Most of them actually are around the 1 hour or the 4-hour chart. So here's another side nugget or side knowledge nugget, is that a lot of people will have a trading strategy for, say, I don't know, the 1 hour or the 4-hour chart. And then they'll get really caught up in fundamental macroeconomics. Putin's doing this, or Trump, or whatever, the dollar's doing this. Largely, it means jack shit. If you're trading the 1 hour or 4-hour chart, like all of that stuff, is relevant, but in a bigger time frame. So rough rule of thumb is that for most strategies, when you place a trade, your trade will play out within 30 candlesticks, typically.
Okay.
Like
of any time frame. That's interesting. Be it 4 hours, be it 1 hour, be it daily.
Exactly. Like, that's a rough rule of thumb. I mean, like, you can have a look at your own strategies, Garth, and you'll probably see, it's probably within 50 candles or whatever. Let's just say it's within 50 candlesticks. Your trade will have entered and exited. Well, on the hourly chart, that's 2 days.
It's interesting you say 30 candles. I mean, look, I generally have a rule where I try and I'll put a stop loss on a trade, a time stop rather, which is often about 30 days, which is well, so 30 days is not always 30 candles because of weekends, right? But I'm also of the view that if a trade is going to work, it's going to work out quickly. And that's been my experience through the years, is that the best trades actually work out and get to their target pretty quickly. And the ones that take their time to get going or don't get going, often it's actually the market telling you that, well, the rest of the market doesn't view this the same way you do. That's why the price is not moving where you want it to move. So take that information and use it.
Yeah, agreed. And then if you get in that situation where you're in a trade and it's stalled, just like you said, all of a sudden you're now in a coin flipping. Will it go? Will it won't? And so I agree. The trade normally, the good ones happen in a few candles.
How do you avoid yourself getting thrown out of a trade if you are in a trade that's a decent trade? And I mean, now we're talking about really volatile things with cryptos, right? I don't trade a lot of crypto. I in fact hardly traded it at all. But I know even with less volatile instruments that I trade, equities and the odd currencies, it's hard sometimes to run a winner because you get the volatility that can then try and shake you out. Do you have particular methods that will enable you to stick around to see the trade through to its target without getting shaken off the horse before it gets to its target?
I struggled with this question for a good 5 years. Like back in the day, and my answer, it will be different for different people. I try and take that thinking out of the equation, because you will scare yourself out of the trade, whether you're snatching too early or you're trying to leave it too long and you're giving loads of profits back to the market. You will always be your own worst enemy. So I try to be as mechanical in nature. So for the trading strategies that I am deploying, the mechanical ones, they will already have their exit criteria as part of the strategy. So it will either be, I'm going to enter this trade, it's going to be a 3R take profit or -1R.
Yeah.
Or it's going to, or if I'm running a trade, I will trail the stop loss based upon a moving average or something like that.
Yeah.
There is always a time stop loss as well, like you mentioned. That's very accurate. So a lot of the mechanical systems, all the thinking's taken away from me. The thing where I do hold my hand up and struggle slightly is more for the spot market. So let's say, for Bitcoin, let's say I finally get back into the market. I buy a whole bunch of crypto, etc., and I run it up. And let's say 2024 is another big year, and moving into 2025, I'm sat there on X 100% profit or 1,000%, typical bull market. Then it's a case of shit. Okay, do I take profit now? Because towards the end of the bull market, you see massive spikes.
Yeah,
always massive spike ups. But sometimes it's several times. Like I remember, I think off the top of my head, when Bitcoin zoomed up to 40K for the very first time, it was a big old candle.
Yeah.
And everyone's like, this is the high. And then, it pulled back down, I think back to 30 or whatever. And, there was the deliberation, or shit, is that the top? And then all of a sudden we had another mini bull market up to 60.
Yeah.
And I know people that, got left on the train station, at 30K, 30, 40. And then I know people that ran it all the way up to 69K and then didn't get out till 30 again. So, so they all end up in the same place. So for me, when it comes to crypto, I'm looking more of the big, bigger fundamental metrics. So for example, Bitcoin still does have a 4-year cycle, believe it or not.
Yeah.
So I'm looking at that. So the next time, I know I'm not sharing a screen, but I just off the top of my head, I should know this. The next topping log chart. Here we go. We should have 2025, sometime 2025. So if all of a sudden we're sat on loads of profits around 2025, I'm gonna probably start taking profits off the table.
Just based on the 4-year cycle.
Yeah. I mean, obviously my opinion will quickly change if there's new data. And that's the thing I hate about YouTube. I'll say something because I lift my pants up all the time, or lift my skirt up. But my opinion does change when there's new data. So
well, that's it, right? You in effect change your view, right?
Yeah.
Change your position. You spoke about the dollar and the correlation to all of the assets, right? We said how it's weaker dollar tends to align with higher risk asset prices, be that equities, be that commodities, be it crypto, and vice versa. So right now, the US dollar index is kind of at quite a critical level. And I want to get your thoughts on it. Those who know the US dollar index, it's an index of the US dollar against 6 developed market currencies. It's the dollar versus the euro, the pound, the Swiss franc, the Canadian dollar, the Swedish krona, and the yen, I think is the other one that I've left out. There's 6 currencies, right? Now, the US dollar, if you look at a long-term chart, the US dollar index is pulled back all the way to a huge area of support, which is at about 100 to 102, call it. So we're in this zone now where either the dollar is going to bounce from that level, or it's going to fail and it's going to fall through that support and continue to weaken. And I'm finding right now that it's quite tricky to make any medium term, longer term bets based on that, because if the dollar does bounce, well, then that's probably going to mean that we see a correction in risk assets. On the other hand, if the dollar continues to weaken through that support, well, then maybe that means we're going to see further upside in equities, in cryptos, in gold, etc. What's your view on the dollar from here?
Oh man, it's all I talk about at the moment with my community. You're spot on. I'm looking at this on my other screen right now. It's sat there on massive support. And there's two main points of two main highs which create that support, which is the high of 2017 and that high of 2020. And if you just draw that line connecting those, like it leads us into basically a head and shoulders on the weekly chart. And right now the right shoulder is, the left shoulder is a bit iffy, and the head's definitely there. The right shoulder is very well formed, and right now we're at the bottom, we're at the base of that right shoulder, so the neckline. And it, like, as much as I study all of the macro type stuff, I would have to say right now it is 50-50. I know, not even 50-50. I don't know is the answer.
I'm glad I'm not the only one, because that's something I'm really grappling with at the moment, because it's like, dollars here, and so much is going to depend on what the dollar does from here. But as you say, does the support hold? Does it fail? But we don't know. I mean, I guess we just have to keep watching and then respond once it's decided what it's going to do.
True. However, there are certain things happening now that have never happened before. So, for example, the dollar hegemony is now crumbling. So, for example, the US has had the petrodollar system since 1975, really, which means that every country on the planet has to convert their native currency into the dollar to do oil transactions. So if India is buying oil from Syria, they both convert into the dollar, and then they do their oil transaction, which means all oil transactions since 1975 have effectively run through the Federal Reserve. And because the Federal Reserve have editing privileges on the US database, i.e. the money supply, the US has effectively had free oil since 1975. So countries over the years have gone, hey, this is shit. I want to stop this. Libya, Iraq, we've seen what's happened to those, countries where they've suddenly had, liberation, Team America. Anyway, so what's happening now is, like, we're seeing a mass exodus of countries from the petrodollar system. So China and Syria, China, Iran, China, Saudi Arabia, Brazil, China. Basically, the BRICS are very overtly moving away from the petrodollar system. So Brazil, Russia, India, China, and South Africa. And the BRICS as a collective whole, I would say, are as big as NATO. Maybe not military-wise. Mind you, Russia and China are pretty big. So, and even Asia right now are calling on for a Pan-Asian monetary fund, which would do exactly what the IMF does. And you have to understand that for decades, the US has basically bullied every country that it's wanted to bully with the threat of the dollar. Do what we say, or we will restrict you from the dollar payment network and SWIFT. Oh, look what they did with Russia recently.
Yeah, they did exactly that.
And they stole $600 billion worth of Russian money recently. So other countries, if I was a random country looking at this going, holy shit, they just stole $600 billion from Russia, as in payments that people made for Russian gas, etc. Now, ignoring obviously what Putin is doing, they literally stole $600 billion. So if I'm a country going, shit, yeah, I'm pretty bored of being bullied by the dollar, how about we cozy up with China? They keep knocking my door, coming up with some nice juicy deals, and that's what they're doing. China have been deploying their checkbook diplomacy for years now. They're buying up huge chunks of Australia. They bought loads of Africa, all over Africa. It's and they're going to countries with really good deals. So why don't I trade my oil for the yuan instead of the dollar? So as a result of that, so I'll get back to point now. As a result of that, loads of countries are, there's a stark less of a demand of dollars, which is why we've had, the dollar effectively peaked in September 2022 and has crashed big time since. And that's because of this.
Yeah, absolutely. But I guess it's also, that's also a function of US rates going up. And the next question is, how high do rates go? And everybody seems to think that there's another 25 basis points hike coming in May. And then after that, the Fed will pause and then maybe pivot and start taking rates down at some stage. But obviously, the further out you look, the less or the more murky the picture is. But I mean, I would also suspect that could also have a consequence for the dollar, right? If they are going to keep rates up, I mean, does that not then continue to support the dollar and mean that the dollar index will hold that support level? Or are we just guessing?
Quite possibly. So when you look at so if you take a step back and look at the biggest metrics from 1950 onwards, it tells such a clear story. It's scary. It's scary how clear this picture is. So let's build them up. And it's annoying. It's unfortunate that I can't share screens because the picture would paint a billion words here. So if you look at interest rates, every single time, basically since 1950, we've had a sharp and dramatic increase of interest rates. That's led into a recession.
Yeah,
almost every single time. Now, if you're going to be very careful when you're looking at that, it's not the rallying into it, it's the sudden drop of interest rates that sparks the crash. So we have massive hike and dramatic rise in interest rates, then they pivot, rates then drop quickly, then the recession happens.
Yeah.
So a lot of people think, oh, well, they're going to drop rates, which means they'll also print money at the same time. Stocks and stuff will go to the moon. No. It's the dropping of rates.
Yeah.
Now, every time they've paused rates for a few months, stocks and assets rally. So here's the key thing. If they pause rates, shit goes up. If they drop them fast, we're in for a crash.
Yeah.
So that's one metric, in interest rates. So right now, we have spiked up at the fastest rates have ever gone up in history. And we're waiting for that, what are they going to do with it? Now, let's then tally this. If you had this big picture of the S&P 500, now let's tally on top of the employment rates. Okay, so this is where it just doesn't make sense at all. Since 1950 onwards, every single time we've had a local low of employment rates, we've had a massive crash. Again, it doesn't make sense. If unemployment's low, we should have there shouldn't be a crash. But no, every single time we have a low in employment rates, we have a crash.
Yeah.
We are now at, I think, the lowest in employment or official employment rates since 1980, something like that. Now, I don't believe those employment rates at all because the way they gauge them is utter bollocks. Anyway,
that's unemployment, right? Just to make it clear. Lowest unemployment rates, yeah. Okay, which means, so full employment.
Yeah, exactly, which doesn't make sense. Anyway, so you now have interest rates and unemployment metrics all saying the same thing. You then put inflation. Every single time we've had raging inflation, guess what's happened next? Crash. So, and then the next thing is inflation. Oh, I had a picture of interest rate. I can't remember.
But it's interesting what you say, because I mean that is it's quite and particularly around the rates and when they start to cut rates, and that's when your recession starts. And I guess it's because you're in a recession that they cut rates, right? That's why the Federal Reserve cuts rates, because they need to stimulate the economy out of a recessionary environment. And when you have recessions, you have stock markets go down.
Yeah, exactly.
Is that your view then from here, that we're facing another leg down in the equity markets?
Like if you go to the Federal Reserve website and then add on all of these metrics into one chart, you'll see that there has never been a time where we've had rising inflation, rising interest rates, and low unemployment where there has not been a recession. Never.
The Federal Reserve have even come out and said they're expecting a mild recession, which is interesting because the Fed never ever comes out and uses the R word. You go back in the past before 2008 and what have you, they said, well, no, don't think there's a recession coming. This time they're actually saying, no, they do think there's a recession. So you wonder if they never thought there was going to be one in the past, and we had a number of recessions, and now suddenly they do think there's going to be one. It makes me ask, well, are we going to have a big one?
Yeah. And on the 14th of April, Jamie Dimon, the CEO of JP Morgan, said, exact words I'm reading it, there will inevitably be a recession.
Yeah.
And you can't get he is way up there in the elites, let's just say, if there was, but yeah, so everyone's calling for that. And also the other thing is that you should always look at what billionaires and big companies do, not what they say. So if you look what they're doing, every big company, it's fair to say they've got better optics on stuff than us, right? They have the best, all the money, best advisors, blah, blah, blah. Before big recessions, a lot of these big companies, they fire shitloads of staff and they borrow money as much as they can. So they get debt assets or debt instruments and they fire people. Or what have all the FANG TM companies done? I think the last time I checked, Facebook, Amazon, Apple, Netflix, Google, Tesla, and Microsoft, they have fired over 250,000 people in the last 12 months.
Yeah.
And a lot of them are doing massive share buybacks and getting debt instruments.
Yeah.
It's like, holy shit, okay. They're preparing for something, because what they're trying to do is they're trying to reduce their OPEX and have the longest cash runway possible.
Yeah.
They're backing up for a storm, basically.
Yeah. Seen this movie before. All right. Interesting. And I mean, we are running out of time now. So yeah, I know you've got to run off to another meeting, and I do as well after this. So we're going to keep it short. What I want to say from here on out, I mean, I think we've got your market view. I've heard about cryptos. We've spoken about the dollar. It's been good. Where do listeners and viewers of this podcast get more of your insights if they want to follow you?
Yeah, so I put loads of free stuff on YouTube. So Siam Kidd.
Yeah.
I have to say I'm not a YouTuber.
Okay.
But I just put stuff on there just for public record, I guess.
Yeah.
And the realistictrader.com.
Realistictrader.com. And then you're also on Twitter, yeah?
Yes, yeah.
And that's what, at Siam Kidd?
Yeah, that's me.
That's you. Okay.
Controversial, then it's me. Yeah.
All right, Siam. Well, it's been good to catch up with you again. I've enjoyed this.
Yeah, likewise.
It's always fun. And
I hope it helped.
It's you know what? Every opinion is worth listening to, and we get differing views coming on this podcast, but that's what makes the market at the end of the day, differing views. And it's been interesting. So thank you very much for your time again. It's been good after 3 years to catch up with you once again. And we'll do this again sometime.
Amazing. Cool.
Thank you so much. Cheers.
Yeah.
Thanks for joining us for today's episode of Talking with Traders, brought to you by IG, a world-leading CFD provider. We really are privileged to have such a leader in the field of online trading involved in this series. Please follow us on Facebook and engage with us there. And a reminder to make sure you subscribe to this series by clicking on the subscribe button on your favorite podcast app. If you've enjoyed this podcast, we'd also appreciate if you'd leave a review on the app too. Till next time.